Welcome back to the Multifamily Deep Dive, presented by Bridgewater Realty Advisors, the local multifamily experts in South Louisiana.
Yeah, it's good to be back. And today, I don't know, it feels a little different, doesn't it?
It does. It really does. We're setting the time circuits to right now, today, January 29th, 2026.
Right.
And, usually we're wading through this whole stack of mismatched articles, trying to piece together a narrative from like a dozen different sources.
Yeah.
But today, the mission it's laser focused.
It really is.
We have our hands on the brand new January 2026 Multifamily Market Insights Report from Bridgewater Realty Advisors.
Right. And the reason we're dedicating a whole deep dive to just one report is because this isn't, a newsletter or some kind of fluff piece. I've gone through it 3 times now. And this thing is a dissectable snapshot of a very specific, very critical moment in the South Louisiana market and the broader economy. It's dense, it's data heavy, and quite frankly, it makes a pretty bold claim about where we are in the cycle.
It really does.
Yeah.
I mean, reading through this, I did not get the usual everything is great, please buy real estate vibe that you sometimes get from, brokerage reports.
No, not at all.
I got a sense of tension. There's this central theme that just runs through the whole document, almost like a suspense movie trailer. The core question they pose is, buy now or compete later?
And that is the pivotal question.
Yeah.
It sounds like marketing copy at first until you actually start looking at the math underneath it.
Right.
We are sitting in what the report identifies as a buying window. Now, we hear that term a lot, it's a window of opportunity. But in economics, a window it's defined by a temporary imbalance.
And this imbalance feels really specific to right now to early 2026.
Exactly. It's unique. You've got interest rates that are meaningfully down from those painful peaks of the last couple of years.
Thank goodness.
And you have lenders who are actually picking up the phone and competing for business again. But, and this is the key, this is the whole thing, the flood of competition hasn't smashed through the gates yet.
Which is the dream scenario, right?
Yeah.
You want to be the only person at the buffet for at least 20 minutes before the tour bus pulls up.
Yeah.
You want the prime rib while it's hot, without an elbow in your ribs.
That's a colorful way to put it, but yes, that's the idea. The report's argument, though, is that the tour bus is already idling in the parking lot. You can hear the engine revving.
So the clock is ticking.
The suggestion is that by summer 2026, that's just a few months from now, the whole dynamic shifts. So while you and I might feel this high energy about the turnaround we're seeing, we need to be cautious. I want to verify if this turnaround is structurally sound or if it's maybe a trap.
Okay, let's unpack this. I want to start with that headline thesis, because it really does set the stage for everything else in the report.
Mm-hmm.
Section 1 opens with this idea of the real cost of waiting.
Mm-hmm.
Now, this triggered me a little bit, because usually when I think of waiting in real estate, I think of safety. Hey, let me just wait and see if rates drop another half point.
Sure. The prudent move.
Or, let me wait until I'm 100% sure the recession is officially canceled. But Bridgewater is saying, hold on, that safety you think you have, it might be an illusion.
It's the classic investor's dilemma, right? But let's look at the mechanics of why waiting might actually be expensive right now. It all comes down to the environment shifting against the buyer as capital returns to the market.
Okay, so walk me through the mechanics of this buying window as it stands right now in January. What are the specific ingredients that make this a window and not just, the normal market?
Okay, first you have to look at the debt. The report highlights that interest rates are down. And look, we're not back to the zero interest rate policy of 2021.
Or should we be?
And we shouldn't expect to be. But the panic pricing from, say, 23 and 24, that's gone. Underwriting is described in the report as more predictable.
Predictable sounds boring. But in this business, after the last 3 years, boring is beautiful.
Well, I wouldn't go so far as beautiful just yet. Let's say predictable is safer, but it also creates its own problems.
How so?
Because when things are predictable, everyone feels safe enough to start bidding on deals again. But right now, we're in this little sweet spot where underwriting is predictable, but that broad-based confidence hasn't fully returned.
So the lenders are back at the table.
They're back. But the second ingredient, and this is absolutely crucial, is the seller sentiment. The report uses a very specific phrase. Sellers are worn down.
Worn down. Oh, I think anyone who has owned a multifamily property since 2023 feels that in their bones. It has been a rough ride.
Incredibly rough. Think about the psychology of the seller right now. They've spent 24, maybe 30 months just battling.
Battling everything.
Right, you're battling rising insurance costs, which, my gosh, we'll get to that later.
A whole other can of worms.
Exactly. And you're dealing with interest rates that maybe doubled or more your debt service if you were on some kind of floating rate note.
Or you had a bridge loan that came due at the worst possible time.
The absolute worst time. So you've been holding on by your fingernails for 2 years. Now all of a sudden rates have dropped a bit. You can finally see an exit ramp.
And you're not looking for a record-breaking price anymore. You just want to get out. You just want to exit with your dignity intact.
That's the key. So you have accessible debt on one side and you have these tired, motivated sellers on the other.
That's the combination.
It is. You have thin competition combined with motivated sellers, and that creates leverage for a disciplined buyer right now. You can negotiate price. You can negotiate terms. You might get some seller financing.
Things you couldn't even dream of asking for 2 years ago.
Impossible. You might get them to cover some closing costs. The report explicitly says buyers can do things now that were absolutely impossible during those hotter cycles.
Okay, so that brings us to the compete later part of the warning. What happens in July? What changes?
That's the concept of fighting the crowd. The
Wow.
prediction in the report is that by summer, as the data solidifies and people, the broader market realizes the sky isn't actually falling,
All that money sitting on the sidelines comes rushing in.
all that capital, and there are literally trillions of dollars of dry powder out there. It floods back in.
And when that money floods in, the thin competition just vanishes.
Right. It's gone overnight. Suddenly, you're not the only offer on the table. You're one of 6. And when you're one of 6 offers, what happens?
Yields get bid up.
They get bid up. All those nice concessions you were asking for, they disappear. You lose all of that leverage you had.
Let's do some quick napkin math here, because I think this is a point people miss. Let's say I'm looking at a $5 million deal today,
Yeah.
and I'm debating waiting 6 months to see if interest rates drop from, say, 6% to 5.5%.
Okay, let's run that. A good thought experiment. So you buy today at $5 million with a 6% rate. Your debt service is X.
Okay.
Now, if you wait until summer and rates do drop to 5.5%, yes, your monthly payment on that specific loan amount goes down. That's true. But what if competition drives the price of that same asset up by just 10% because there are now 5 other bidders?
So the building now costs $5.5 million.
Correct. So now you're borrowing more money. Even at that slightly lower rate, your debt service, your actual monthly payment, might be higher.
Wow.
Or even if the payment is roughly the same, your down payment just jumped significantly. You're putting way more cash into the deal just to get the same return.
So you saved 50 basis points on the rate, but you overpaid by $500,000 for the building.
Precisely. That is the real cost of waiting. You're stepping over dollars to pick up dimes. The report is arguing that the price of the asset is far more sensitive to competition than the monthly payment is to a small incremental rate drop.
That's the kind of math that keeps you up at night. Okay, let's move from the abstract warnings to the hard numbers, because this report is full of them. Section 2 gives us a January 2026 snapshot of rates and financing. And I have to say, seeing a number that starts with a 5 felt like seeing a unicorn.
It's a huge psychological barrier, isn't it? I mean, breaking back into the 5% range, it just changes the whole mood in the room.
It really does. So let's run down the list they provided. They give us 3 specific benchmarks. First, U.S. Bank is offering a 30-year fixed mortgage at 5.99%. Second, Bank of Louisiana, our local representative here, is at 6.75%. And third, a DSCR loan for multifamily is sitting at 5.95%.
And those are the benchmarks, and they tell a really complex story if you know how to read them.
Well, help me read them then. The 5.99% from U.S. Bank is the headline. We're back in the 5s. But I'm looking at that spread. Why is the local bank, Bank of Louisiana, almost 3/4 of a point higher at 6.75%? If I'm a borrower, why wouldn't I just sprint to U.S. Bank for the 5.99%? I mean, why would anyone pay 6.75%?
This is where you have to understand the difference between what I call commodity lending and story lending.
Break that down for me.
Okay, so a large national institution like U.S. Bank offering 5.99%, that's a commodity product. It comes with a very, very rigid box.
A checklist.
A checklist. Their underwriting is algorithmic. They need a specific credit score, a specific asset class, a specific occupancy history, and probably a specific net worth from you, the borrower. If you and your deal fit in that box perfectly, great. Take the 5.99% and run.
But what if the property has a little hair on it?
Yeah.
Maybe the vacancy is a little high because the previous owner was one of those worn down guys and just stopped leasing?
Then the computer at U.S. Bank says no. Simple as that. And that is where the local player, Bank of Louisiana, at 6.75% comes in. That's story lending.
Ah,
You can sit across the desk from a real loan officer in South Louisiana and say, look, I know the vacancy is 20%, but here's my plan. I know this street. I know that a new coffee shop is opening next door. I know the comps. The local bank understands the intrinsic value of that piece of real estate better than a national algorithm ever could.
so you're paying the premium, the
Yeah.
6.75%, for the flexibility and the relationship,
Yeah.
for the certainty of closing.
Exactly. Sometimes the cheapest money isn't the most available money. You pay a premium for the certainty of execution.
That makes total sense. Now, look at the third number, because this one weirds me out a little. DSCR at 5.95%. For the listeners who might need a refresher, DSCR is debt service coverage ratio, and usually these are loans for investors who don't want to show their personal tax returns, right?
Correct. DSCR loans are underwritten primarily on the asset's cash flow, not the borrower's personal income. They're asset-based.
Okay, so here's what's strange. Usually DSCR loans are the easy money, so they carry a higher rate. You pay a premium for the convenience of not having to show your tax returns. But here, the DSCR rate at 5.95% is effectively the same as the prime U.S. bank rate, and it's significantly lower than the local bank.
Right.
How's the easy money cheaper than the hard money?
That is a massive anomaly. I'm glad you pointed that out. And it signals something very, very specific. The private capital markets are getting aggressive.
The non-bank lenders.
The non-bank lenders. The funds backing these DSCR loans are hungry for volume. They have raised a ton of capital that they absolutely need to deploy, and they're willing to compress their own margins to win deals away from traditional banks.
Yeah. So as a borrower, this is a buffet of options. You have choices you didn't have a year ago.
It is. It tells me that liquidity has returned to the market in a big way. A year ago, you were practically begging for a loan. Now, you have national banks, local banks, and private funds all putting distinct competitive offers on the table.
But again, the report slaps that label on this whole environment. Tactical. This isn't a free-for-all like 2021 where you could buy a shack with a leaky roof and get a loan.
No, absolutely not. It's a market for what the report calls informed buyers. You have to move decisively to find that leverage before the competition ramps up. It's about being surgical.
What do you mean by surgical?
You need to know which lender fits your specific deal. If you take a story deal to a commodity lender like U.S. Bank, you're going to waste 60 days and get denied at the finish line. You have to know the players.
And being surgical requires knowing the patient's history. And this report does a really good job of visualizing the trauma of the last few years. They have this market health index chart that walks us through the last 36 months. Well, it looks like a heart monitor of a patient having a cardiac event and then stabilizing.
It's a perfect visualization of the cycle. And you really can't understand the opportunity that exists today without understanding the scar tissue from yesterday.
Let's walk through the phases then. They start with phase 1, the reset, which they say ran from mid-2023 to early 2024. The report calls it a necessary but uncomfortable reset.
Uncomfortable is the understatement of the decade. I mean, let's just paint the picture of what was happening in mid-2023. You had the Fed hiking rates at the fastest pace in history.
There's a shock to the system.
A total shock. You had all these bridge loans, short-term floating rate debt. They were just exploding. People who were paying 4% interest were suddenly paying 8 or 9%.
And at the exact same time, insurance premiums here in Louisiana were doubling, sometimes tripling.
Exactly. So your expenses just skyrocketed overnight. The report describes this phase perfectly as a standoff. You had sellers who were anchored to their 2021 valuations. They were still thinking, my building is worth $5 million.
But the buyers were looking at their new interest rates and insurance quotes and saying,
Based on my new debt costs, I can't pay more than $3.5 million.
and so nothing happened. The whole market just froze. Transaction volume completely collapsed.
It was a deep freeze. And the report makes a great point here. The assets themselves weren't broken. People were still living in the apartments, they were still paying rent, but the expectations were broken. Everyone just froze, waiting for the other side to blink.
And then someone blinked. Phase 2 in the report. Capitulation in the bottom. This is marked as mid-2024. The chart shows the market health index hitting its absolute trough.
Capitulation is a heavy word. In financial markets, it means surrender. It's that painful moment when the sellers finally realize, okay, 2021 is not coming back. If I want to sell this building, I have to sell it at today's price.
That sounds incredibly painful for those owners.
It was, but it was also necessary to clear the market. The report says pricing adjusted, creative financing emerged, and disciplined buyers stepped in. They call this the point of maximum imbalance between fear and fundamentals.
Maximum imbalance. That's usually where the fortunes are made, isn't it? When everyone else is terrified, but the building is still standing and collecting rent.
If you have the stomach for it, yes, that was the absolute bottom. If you bought a property in mid-2024, you likely timed it perfectly. You bought when there was blood in the streets, but that window was terrifying. Most people couldn't pull the trigger.
Which moves us to phase 3, the inflection in late 2024. What was the catalyst?
The trigger here was the Federal Reserve. They started cutting rates, but I think more importantly, they signaled a policy pivot. It wasn't just the one cut, it was the promise that the hiking cycle was officially over. That signal of stability allowed the market to enter what the report calls a normalization phase.
And that leads us to where we are now. Phase 4, recovery and health, late 2025 to present.
Right. And now look at the metrics they're citing. Cap rates are stabilizing. The bid-ask spreads that gap between what sellers want and buyers will pay. It's narrowing.
People are agreeing on price again.
Exactly. Transaction velocity is improving, deals are actually closing, and pricing is firming modestly.
Okay, so if mid-2024 was the absolute bottom, have we missed the boat? Did we miss the opportunity?
That's the question everyone always asks, did I miss it? The report argues, and I think correctly, that we are in the early stage of a longer recovery cycle.
So not the beginning of the end, but the end of the beginning.
That's a good way to put it. You missed the absolute bottom, yes.
Yeah.
You missed the distress pricing. But you are now in the recovery phase. The opportunity now is buying quality assets with conservative, realistic assumptions before the next expansion phase makes everything feel expensive again.
So you're not digging through the bargain bin for broken properties anymore. You're buying blue chip assets before the rest of Wall Street realizes they're on sale.
Exactly. But to really understand where pricing is going next, we have to look at the engine room of the economy. And that brings us to Section 4 of the report, macroeconomics, specifically Treasuries and the Fed.
Okay, I know some listeners' eyes might glaze over when we say 10-year Treasury yield, but the report calls this the direct catalyst. So we have to get technical for just a second. Why is this one number the center of gravity for everything we're talking about?
It's everything, because the 10-year Treasury yield is the risk-free benchmark for the entire world. It sets the floor for all other lending. If the U.S. government will pay you, say, 4% to hold a bond with literally zero risk of default, why would you lend money on a riskier apartment complex for 4%?
You wouldn't.
You wouldn't. You'd demand a risk premium, a spread on top of that Treasury yield. And historically, for something like a 30-year mortgage, that spread is about 1.5% to 2%.
So if the Treasury is at 4%, the mortgage rate is going to be somewhere around 5.5% to 6%.
Correct. So as the 10-year Treasury yield moves, mortgage rates are mathematically tethered to it. They move together up and down.
Now, the report outlines two scenarios for where this yield could go. And this is where it gets really interesting because both scenarios seem to lead to the same place for real estate investors.
It's a bit of a heads I win, tails you lose situation for interest rates right now. Scenario A, they outline, is aggressive cuts.
So, good news.
Right? If inflation falls faster than the Fed expects, the market will price in deeper and faster rate cuts. That pushes the 10-year yield down. Simple enough.
And scenario B is recession risk, or what they call a flight to safety. This is the counterintuitive one. Walk us through that.
Okay, so if the economy gets shaky, let's say hiring slows down, or GDP growth weakens, investors get scared of the stock market, they get scared of corporate bonds, where do they run with their money?
To the safest asset in the world.
U.S. Treasuries. When everyone rushes to buy Treasuries, the price goes up and the yield goes down. So think about it. If we have a booming recovery with low inflation, rates go down. If we have a scary recession, rates also go down.
The only thing that messes this up is if inflation spikes again unexpectedly.
Right. That's the one big risk. But assuming inflation stays tamed, the pressure on rates from either a good economy or a bad economy is, for now, downward.
Now, let's talk about that spread mechanic again, because this is a bold prediction in the report. They note that if the 10-year Treasury dips into the low 3% range, we could see mortgage rates in the low 5% or even high 4% range.
Just think about that for a second. High fours. That changes the math on every single real estate deal in the country.
But wait a minute. If rates drop to the high 4s, doesn't that just mean that asset prices will skyrocket? Are we back in a bubble?
That is the catch, and that's the whole point. Cheaper financing expands the buyer's purchasing power. If you can borrow at 4.75% instead of 6%, you can pay significantly more for the building and still make your numbers work.
It compresses cap rates.
It absolutely compresses cap rates. It causes asset values to re-rate upward across the board.
So we are right back to the real cost of waiting. If you wait for that 4.75% rate to show up on a term sheet, the price of the building might have already jumped 15%.
Exactly. The math changes before the mood changes. By the time you read in the Wall Street Journal that commercial real estate is back, the prices have already adjusted. The smart money moves on the anticipation of the shift, not on the confirmation of it.
Let's descend from those macro clouds down to the street level. Section 5. Inside the market. What are we actually seeing on the ground? The report mentions that transaction volume is up.
It is. National multifamily sales volume increased roughly 9% year over year in 2025.
9% doesn't feel like a massive boom, does it?
No, it's not a boom, but it's a thaw. It signals renewed momentum. It means the gears of the market are unstuck. The sidelines narrative is real. Buyers who sat out for 2 years are actively re-engaging and kicking tires again.
And what about pricing reality? We talked about sellers being worn down. Are they actually taking hits on price? Is there data on that?
There is, and this is really important data. The report says many properties are currently trading at approximately 80 to 85% of their original list price.
Wow. So if a guy listed his apartment complex for $10 million back in that standoff phase of 2023, he's selling it today for $8 or $8.5 million.
Roughly, yes. And that 15 to 20% discount is the reset in action. That is the equity that was essentially wiped out by the rate hikes. But the fact that deals are trading there means sellers have finally accepted reality. That's what clears the market and allows it to move forward.
Okay, now here is where we need to put on our skepticism hats. Let's talk about operations. You buy the building, you still have to run it, and the report is a bit of a mixed bag here.
It is, and you have to be honest about the fundamentals on the ground. Locally, here in South Louisiana, the report describes rent growth as subdued. It even notes that in many local submarkets, rents have actually fallen over the past year.
That's a red flag. I mean,
Yeah.
You're telling me to buy into a market with falling rents.
It's a caution flag. It definitely is.
Oh.
It means you cannot underwrite aggressive rent bumps right now. You can't assume you're going to raise rents $100 in year one like you could in 2021. Demand is soft. However, and this is a massive however for our region, there is a huge win in the expense column.
Insurance.
Insurance. For the last 3 years, insurance was the deal killer in Louisiana. We saw premiums go from, $600 a door to $1,500 or $2,000 a door. It just destroyed net operating income.
It made deals impossible to pencil out.
Impossible. But the report shows a graph, and this is maybe the most important chart in the whole document for a local investor, where insurance premiums peaked in mid-2024 and have leveled out.
They've stabilized.
They have stabilized. They're not going back to 2019 levels, let's be clear, but they've stopped going up at that terrifying rate. For a buyer in, say, Ohio, maybe that's a minor detail, for a buyer in Baton Rouge or New Orleans, that is everything.
Because you could underwrite with confidence.
Yes. If you know your insurance cost is capped, or at least predictable, you can build a real pro forma. It removes the single biggest unknown variable from the entire equation.
So the expert takeaway here is, don't buy for speculative rent growth right now. Buy because the entry price is low, call it 85% of the old list price, and the biggest expense line item is finally stable.
Precisely. It is a tactical play. You are buying the stabilized expense base and the discounted price. You are not buying a rent explosion.
Speaking of where to buy, let's talk geography. Section 6 of the report spotlights Louisiana's growth corridors, and it identifies 2 specific highways, I-20 and I-12. Let's start up north with I-20.
Yeah, the I-20 corridor in North Louisiana, think Monroe, Ruston, heading over towards Shreveport is a fascinating story right now. Historically, a lot of institutional investors overlooked it, but the economic drivers there are shifting in a big way toward logistics, technology, and data infrastructure.
And we have to talk about the 800-pound gorilla in the room, the metadata center.
The announcement of the metadata center near Richland Parish is a tectonic shift for that entire region. We're not just talking about a warehouse with some servers in it. We are talking about a hyperscale facility that will draw immense resources.
I think people underestimate what a data center really means for a local economy. They think, oh, it's just computers. Computers don't rent apartments.
That is absolutely the wrong way to look at it. First, think about the construction phase alone. You're talking thousands of specialized, high-paid contractors who need housing for 3 to 5 years. Then think about the permanent infrastructure. To run a facility like that, you need massive power grid upgrades, new fiber optic lines, road
And
improvements.
famous multiplier effect.
Exactly. It reinforces I-20 as a strategic economic spine for the state. It signals to other tech companies, Amazon, Google, Microsoft, that this region has the power, the land, and the political will to support these massive projects. It creates a cluster. And once you have a cluster of high-tech infrastructure, you get all the support industries, you get specialized maintenance companies, security firms, logistics, and those people do rent apartments.
So it puts North Louisiana on the map for global capital
Mm.
in a way that, say, agriculture or even oil and gas never quite did.
It diversifies the economy in a huge way. It's a massive buffer against the volatility of commodity prices.
Okay, now let's head south to the I-12 corridor. This is the stretch running across the North Shore, so Covington, Hammond, Slidell, reaching over towards Baton Rouge. The report calls I-12 one of the most consistent growth engines in the state.
And it is. I-12 is the classic commuter belt. You have people who work high-paying jobs in Baton Rouge or New Orleans, but they don't want to live with the city density. They want the school districts in St. Tammany Parish. They want the safety. They want more square footage for their money.
It's the classic suburban migration story we've seen all over the country.
It is. But in Louisiana, it's also accelerated by environmental factors. A lot of people feel safer from flooding on the North Shore in many areas. The report highlights that this corridor benefits from really strong commuter demand and, crucially, available land for new development.
So how does that connect specifically to multifamily?
Well, where people move, housing has to follow. But specifically, it's affordable housing. As single-family home prices in places like Mandeville and Covington continue to rise, the service workers, the teachers, the nurses, the firefighters, they get priced out of homeownership.
So they turn to high-quality rental communities.
They turn to high-quality multifamily. So if you're an investor, you want to be where the population is growing. And in South Louisiana, all the census data points directly to the I-12 corridor.
It's the path of progress strategy. You don't try to create a market, you just stand in front of the one that's already moving your way.
Always follow the infrastructure. Follow the widening of the highway. Follow the new power lines being built. That's where the real rent growth is going to be in 5 years.
So we've dissected the whole report. We've looked at the cost of waiting, the new interest rates, the market timeline, the macro picture, and the local hotspots. Section 7 is where we have to synthesize all of this. What is the why and the what now?
If I had to summarize the opportunity in one phrase, I'd call it a perfect storm, but a positive one for buyers. Just look at the stack of factors we've discussed. 1, rates are down to a manageable level.
5.99%.
2, sellers realistic. They're trading at 80 to 85 cents on the dollar from their old wish price. 3, insurance costs have finally stabilized. And 4, maybe most importantly, the competition is currently low.
It's the Goldilocks zone. It's not too hot, not too cold.
It is, but the porridge is heating up fast.
And that's the risk, isn't it? The report explicitly warns, if you wait until summer hoping for further rate cuts, the environment shifts against you.
We circle right back to where we started. The risk today isn't that the market crashes again. The risk is that the market recovers faster than you can get a deal under contract and closed. The market has moved from distress in 2023 and 24 to normalization now. The smartest money always moves when clarity returns, which we have now, but before confidence peaks.
Because when confidence peaks, prices peak.
Exactly. You want to buy when people are just starting to smile again, not when they're popping champagne corks. By the time the champagne is flying, the cap rates are already compressed and the easy money is long gone.
Well, this has been an incredible breakdown. Let's recap the key points quickly for the listener who's maybe driving and can't take notes right now.
Sure, let's do it. 1, rates are back in the manageable range, 5.99% for fixed debt, but don't ignore your local banks at 6.75%. They get the story deals done. 2, volume is up 9%. The market is liquid again. You can actually buy and sell. 3, geographically, look at the I-20 and I-12 corridors. That is where the state and federal infrastructure money is going. Follow the money.
And number 4, the big one.
And 4, the window is open right now, but the crowd is coming by summer. The clock is ticking.
And the data suggests that this window requires action before the summer heat, both the literal heat and the metaphorical market heat.
Action based on data, not just emotion, you know? Don't try to catch a falling knife, but don't miss the bus when it's leaving the station either.
I want to leave you, our listener, with a final provocative thought, just something to mull over. We talked about the metadata center, and we talked about global treasury yields. It is absolutely fascinating to think that the rent check for a 20-unit apartment complex in Richland Parish is influenced by a tech giant in Silicon Valley and a bond trader in New York City.
It really is. Real estate feels so local. You kick the bricks, you fix the leaky toilet. But the value of that real estate is ultimately determined by these massive global capital flows.
It raises the question, how much of local real estate is actually driven by the local economy anymore versus these huge global tides? Are we ever truly just a local market in 2026?
That's the multi-million-dollar question, isn't it? And in a connected world, probably not. Everything is correlated to some degree.
Something to think about. That officially wraps up our deep dive into the January 2026 Multifamily Market Insights. A huge thank you to Bridgewater Realty Advisors for providing the data and the report that made this all possible.
Indeed. Stay curious and stay disciplined out there.
And we will catch you on the next deep dive.
Goodbye, everyone.